Duncan，我係個 President and CEO at CWC Energy Services。今朝我哋會講一個 very exciting story about CWC. So I'll now talk in English for the rest of the presentation. I just thought I'd share some of my Chinese heritage with you. Okay, so first of all, our lawyers asked us to put a forward-looking statement in here because they think that I can't predict the future, but I have to remind them that I am of Chinese heritage and we did fortune cookies, so I might know something about what I'm talking about here. So a little bit about the company snapshot. I thought it would be interesting to show where we were in December or at the end of last year, and then in May, and then where we were at the end of September. Traditionally, we have been trading at a EV to EBITDA multiple around 5 to 6 times in our history, in our 17-year history. That made us at the end of December with almost $19 million worth of EBITDA, about $119 million enterprise value company. Fast forward to the Russian-Ukraine war that occurred in March timeframe and the run-up in energy prices. And we ended up increasing our stock price from 16.5 cents at the beginning of the year to 30 cents, which resulted in a EV/EBITDA multiple in around 5 times and giving us an enterprise value of about $182 million on higher EBITDA for 2022 being in that 35 to 37 million range at that time. Fast forward again here to our record-breaking results in Q3 of 2022. We are now increasing our estimates for the year ended 2022 to the $43 to $45 million EBITDA range. However, the stock price is at the end of September dropped down to a 19-cent range. That gives us a multiple of about just over 3 times. While the stock price has now improved after our Q3 results, stellar Q3 record results, to about 29 cents here yesterday, that's still a multiple, EV/EBITDA multiple of about 4 times. And historically, as I said, we have traded in around 5 to 6 times. So there's still more room to grow. On a tangible book value basis, we're about 39 cents a share. So at 29 cents, it still has not reached the tangible book value of the company. And so we think that an investment even here at 29 cents is a good value for our shareholders. Insiders of this company own 64% of the stock. We have had a 52-week range now of around 13.5 to 32 cents. And the volumes on our stock have been increasing throughout 2022. As you can see, for the 9 months ended, we're at 26.8 million shares traded versus all of 2021 at 27 million. So there's more interest in the story. So why do you need to listen to this story about CWC? 2022 is going to be a record year for CWC. We have already broken for the first 9 months record revenue, record adjusted EBITDA, and record net income in our 17-year history. Every available crew that we have on our rig is working, and if we had more crews, we'd have more rigs working. We have been successful in crewing our rigs, increasing our headcount this year by 200 people to 720 people, 650 of those being field employees. And this is a higher number than our pre-COVID numbers of February 2022, where we had 620 employees. So we have been successful in the labor shortage challenges that we have in our industry and being able to increase the number of people working on our rigs. So what is the growth pattern for CWC? Well, we did 2 transactions here, and I'll talk about the first one being a 10 triple drilling rig acquisition in November of 2021, where we bought 10 high-spec triple drilling rigs in Casper, Wyoming for $17.3 million or US dollars, which is approximately 21.4 million Canadian dollars. This acquisition was done at 8 cents on the dollar to build brand new for these rigs. So we paid roughly $2.1 million per drilling rig for what would cost new to build about $42 million to build new. We think that the EBITDA contribution in 2022 is going to be about $14.8 million from these rigs, and that's a purchase price multiple about 1.4 times, meaning we will have paid back this investment in about 1.5 years. We are going to work these rigs in the Montana, North Dakota, Wyoming, Utah, Colorado region, and longer term, we intend on migrating some of these rigs to New Mexico and Texas. Following that transaction, that great transaction and great price that we bought these assets at, in June of this year, we bought 3 more high-spec triple drilling rigs for a purchase price of 7.4 million US, which equates to about 9.6 million Canadian using our credit facilities. Our board also increased our CapEx budget by 8.3 million to do the upgrades and level 4 recertifications on these 3 triple drilling rigs for a total investment then of $17.9 million. We estimate that the rigs for these 3 rigs were purchased at 5.9 million, and again, to build new on these rigs would have been $42 million to build new. We think that's a really good metric for our shareholders at 2.4 times in terms of the cash flow generation. And this further expands our presence in the United States, increasing our drilling rig fleet to 22 drilling rigs, 7 heavy doubles and 8 AC triples and 5 DC triples and 2 heavy doubles in the United States. So a little bit about the asset mix and the financial summary. We have 7 Canadian drilling rigs. All 7 are active today. We have 15 US rigs, 12 of which are active right now. As of last week, the 3 that we bought in June have now been recertified, and we're actively marketing those rigs to customers. On the production services side of our business, we have 143 service rigs, 63 of which are active today. That makes us one of the largest service rig companies by operating hour and rig count in the Western Canadian Sedimentary Basin. You can see in 2022, the rough split of our contributions from contract drilling versus production services is about 50-50. But we think into 2023, the US business is going to get larger based upon the assets that we bought in the United States here, contributing about 41% to revenue and 50% to EBITDA. So now our contract drilling division is going to be a larger contribution to our overall business of roughly 60% compared to 40% on the production services side. So where is it we work? We're right throughout all the prolific basins in Canada and the United States. You can see that through this map, all of the oil and natural gas basins, we are in those active basins here today. A little bit more about our drilling rigs. We have 8 AC triples, 5 DC triples, and 9 heavy doubles. 7 of them are in Canada and 15 of them are in the United States. This is one of the most relevant fleets in Canada and the United States, operating in the most active basins, being the Western Canadian Basin, the Permian, the Eagle Ford, the Niobrara, the DJ Basin, the Powder River, and the Bakken. Our rigs go down to about 7,600 meters, and we thought that we would kind of classify these rigs in terms of basins, and that's really based on hook loads. And you can see that the bulk of our 22 drilling rigs, 12 of those rigs have 222 decadents, which is the hook load capable of going down to the depth levels that are required in those basins. And so this is a very, very relevant fleet. 17 of the 22 rigs have pad rig walking systems. 9 have 7,500 PSI pumping systems. 3 are carbon reduction biofuel systems, meaning changing from diesel to natural gas at the request of the customer. And 2 of these are electrified in the sense that they can take power from highline power poles that are in the region. And what you see here from a pictures perspective is our Rig 1, which is the very first rig that we built, and Rig 120, which is our high spec rig in the United States that we just bought. I thought I'd show here the 5-year average for the rig count in Canada. The shaded area is your 5-year average. The bottom is the low year. The top is your highest year in the 5-year range. and where we have come from 2020 to 2022. 2020 is the dotted blue line. The 2021 is the gold or yellowish line in the middle, and 2021 is the gold line. 2022 is the blue line on top. As you can see, we are now trending at the top of the 5-year range, and I believe that 5-year range is probably 2018. We are trending at the top of 2018 for drilling activity in the Canadian Basin. So basically suggesting that drilling activity is very robust in Canada. We have topped out around 230 rigs as a total industry in Canada, and as you can see in 2022, for the winter season, which is usually our busiest time, January, February, March, we were unable as an industry to get back to a 250 rig count basis. Primarily that is because of labor shortages in our industry, and had we had more people, we could get to those type of levels. I do anticipate that it will be a struggle to get there again in 2023, but that just means that our pricing is going to be extremely strong in terms of demand versus supply of drilling rigs. Looking at the US activity on drilling rigs, you can see the shaded areas here is the rig counts for oil and natural gas. Left side is oil and right side is natural gas. You can see that from a total rig count perspective, even though oil prices and natural gas prices have skyrocketed to historically high levels, our rig counts have not gotten back to the same levels as they have, say, the 2011 era. And I don't anticipate that we will get to those 2011 eras just because we've become much more efficient with our drilling rigs. But even trying to get back to 2018-19 levels, we aren't at the top. So that represents growth potential for the US market in terms of rig count. On our service rigs, we have 143 service rigs. 75 of these rigs are singles, 54 are doubles, 14 are slants, 63 of them are active, and we have 80 parked. Of those 80, I would suggest to you 20 could go out in the field tomorrow if we had rig crews. We are the second largest service rig company in Canada by active fleet and operating hours, and these rigs go down to about 5,000 meters, which is the active parts of the basin for the Canadian Basin. We focus mostly on the maintenance, workovers, and well decommissioning work versus completions, and the reason we do that is because it's a much more steadier work for our field crews. So for those who are unfamiliar with what a service rig does, a service rig goes back to the same well about 7 to 8 times in its life if it's an oil well. And so it does work at the very top left part of this graph here. When you first drill a well, it gets drilled, then it gets fracked, then you bring in a service rig like ours to go and lay pipe down holes so the oil or natural gas can flow out of the pipe. As the reserve declines in terms of its production, a service rig would be required to come in to do maintenance work. Then when it gets to a certain level where what we call workover in our industry, to increase the production of that well, the oil and gas company would have us come back out and do some circulating work and removing sand and buildup that then ends up producing more out of that well. The production life goes up. Of course, as the well ages again, it declines. We go back in, get more production until the very end of the life of that well, where that well is to be considered to be inactive. And at that point, we go in and do well decommissioning work. So this is as repeatable a business model in the oil field services space, going back to the same well over and over and over again in its life, on average about 7 to 8 times. On the service rig hours here, the black line here is our 2022 service rig hours. You can see that we are tracking close to our 2019 levels. The blue line is 2018, where we had a record year following the purchase of one of our competitors in late 2017. We had the most hours, and then dropped off because of production curtailment that started in November of 2018. The challenge here for us to get back to the 2018 type numbers is really rig crews and the shortage of labor to get back to those 2018 numbers. But that doesn't mean that we don't have the equipment. We're just short manpower. Okay, a little bit of financial results of our company. We will do over $200 million in revenue this year. As I said previously, we're at about 43 to 45 million of adjusted EBITDA. We already have 32 million for the first 9 months, as we reported last Friday. That gives us a net income for the year around 20, in the mid-range, around $22 million. Our long-term debt is forecasted to be in the mid-40s, about 46 million to 48 million. Leaving us in a net debt position of $10 to $12 million. So extremely good leverage metrics here. In 2023, we think it's going to be another record year for us, and that's not based on more speculative. It's really the adjusted EBITDA range of 51 to 54 million is based upon a full year's working of our U.S. drilling rigs that we acquired. We didn't get all of those rigs, 6 out of those 10 rigs that we bought, working until about April, May timeframe. And so the increase here is going to be for a full year period of our U.S. drilling rigs, as well as the 3 rigs that we just bought in June, which we think we will be working in the first half of 2023. This is a trailing 12-month revenue and adjusted EBITDA chart. The bar chart is the revenue, the line chart is the EBITDA. And as you can see graphically, we are headed higher in terms of the results of our company. And something to note here, if the line chart hits the top of that bar chart, that's about a 20% margin. You can see that our margins are increasing. We're now at around 26% margins to EBITDA margins to revenue. And so that's a very healthy margin, allowing us to put money back into our equipment, as well as giving returns to shareholders. On the CapEx front, we have a $30.3 million CapEx budget for 2022, of which 17.9 was for those 3 rigs that we just talked about, that we bought in June. And you can see from a maintenance CapEx, we are a sustainable maintenance CapEx in around $4 to $7 million a year. So sources and uses of cash. We're going to generate in around 42 to 44 million of adjusted EBITDA this year. Our interest costs are around 2.5 million, even as interest rates increase. Our CapEx this year is a bit higher just because of those acquisition of those 3 rigs, leaving us with free cash flow in around 10 million to $11 million. Next year, our free cash flow is going to increase significantly into the $30 million range. And we think that our first priority is to pay down the debt in 2022, but we may be in a position to distribute or return a portion of that free cash flow to shareholders through dividends or share buybacks in 2023. As ESG is much more important these days, we are very proud to have released in June of 2022 our second ESG report, which profiles our ESG profile in our company. 17% of our total revenue was on well decommissioning work, so basically putting the environment back into the original position that it was before any drilling activity occurred. 2% of our revenue were on things that were not oil and natural gas related, that being carbon capture, helium, saltwater disposal wells. And this year, in June of 2022, we made history drilling Alberta's first 2 lithium brine wells for one of our customers. We think that much like Leduc No. 1 in 1947 for Imperial Oil, created a brand new industry in Alberta for drilling for oil and natural gas. We think that the lithium brine well that we just drilled here in June of 2022 will open up a brand new industry, and one day we think that our CWC Iron Hand drilling rig number 9 will be immortalized in museums. Our safety record is impeccable. We had a TRIF rating, a total recordable incident frequency of 1.22, which is a very low rating in our 17-year history. I am proud to say that even as our man hours increase this year, we are lower than 1 now for the 10 months ended 2022. And so we're very proud
Duncan,
of our.
You may like to wrap things up because if you can squeeze in 1 or 2 questions.
Okay, yeah, really good, real good. So I just want to share the last slide here, which is our share price performance. We're one of 2 companies to have received a share price performance of over 100% from January 1 to September 30th, 2022 in the contract drilling and well servicing space. And so this is even as you can see from this chart, even when we dipped during COVID in March of 2022, we rebounded very quickly back up into positive territory. And so we're very proud of that record and this management team. Happy to take questions here.
Yeah, let me just try to squeeze in a couple of questions here. Time's running out. The first one is from Carrie. Is it safe to say that your business relies heavily on a strong energy market?
I would suggest to you that we are in a robust market and a continuing upward trend on oil and gas. What the market does not seem to appreciate right now is that while everybody's focused on the demand side of the equation, being demand destruction due to a global recession, what they don't appreciate is looking at the other side of the equation, which is a supply shortage globally. There are only a couple of countries that can increase their production here. Everybody else is either declining or staying flat. And those two countries are Saudi Arabia and a couple of other OPEC nations. And those countries are being extremely price disciplined right now with regards to keeping oil prices high. So I think that this is a multi-year run in the North American oil and gas, natural gas industry.
So one last question here, squeeze in from Bruno. Is this energy service very competitive in your space? And did you need to cut your price during the downtime before to get clients?
Yeah, I would suggest to you that given the amount of free cash flow happening in our customers, they are not as focused on squeezing every penny that they can get from the service companies right now. That's why our margins are increasing. That's why even as inflation happens from fuel, supplies, and labor, that we can pass that on to our customers and then keep even more to the bottom line. So our EBITDA margins have been increasing from that 15% of the low point to now in the 26% range of EBITDA margins.
Thank you for sharing your story with us here today.
Thanks, Gilbert.
Thank you.